Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to delve right into this thing about annuities I've been talking about now. We talked about how to invest in the market, how the smart money invests. Now we're going to talk about safe ways that you can also apply money, and sometimes, many times, in fact, the best way is some blend of these, and the blend as far as the stocks in index annuities depends on your specific situation, which is why we offer up the retirement income analysis, okay, so that you can deal with your specific situation. So again, for the first 10 callers to the show this morning, I'm sorry, not to the show, to my office this morning, 615-376-5325, first 10 callers, free retirement income analysis. And this is a big part of understanding. I'll answer all your questions at that appointment, and I'm not going to keep you on a clock, okay? We're going to give you as much time as we can. And sometimes we might even meet a second time if it's in your best interest, and we're, accomplishing goals that we need to accomplish. So for the first 10 callers to my office, 615-376-5325, Debbie's standing by to take your call. She'll get your information, send you out a checklist of things to bring to our meeting. And she'll also send you out a free copy of my book, 7 Steps to Financial Freedom in Retirement. And that deals a lot with some of the things we've been talking about this morning, of course, in even greater detail. Now, one of the things when it comes for annuities is understanding what role they play. All right, first off, they can, when put together with a good portfolio, this is another way that you can reduce your volatility, your risk. All right, at the same time, it's a way that you can get other guarantees. All right, so let's take a look at the next slide. And this one has to do with the benefit of a broadly diversified approach. Okay, so the benefit of a broadly diversified approach, and then we go on to the next one. Let's see, on that one, Marilena, if we have, what's the next one? This one starts, benefit of a broadly diversified approach. There we go. So I talked about diversification and the 19 asset categories in a portfolio and how it reduces volatility. It doesn't eliminate it. You're going to still have negative years. So again, you have to pick the right asset allocation to control what the, in other words, once you determine you've got the right portfolio, then it's still a matter of how much is going to be in equities versus the fixed side to control that volatility even more. So this approach, and this is the J.P. Morgan Mosaic Index. This is another way, another diversified approach. This one is using 12 asset categories to create the flexibility to adapt to a variety of market conditions and help with returns. So if we look at it, in fact, on the next slide, what this does on the J.P. Morgan Index is it is giving us, it takes the 12 asset categories, it looks at their past performance over the last, this is harnessing positive momentum. So on harnessing positive momentum, what we're looking at is saying, well, what are the 12 asset categories? They evaluate each month which ones did the best over the last 6 months. They then select the top 6. They then take that top 6 and they weight them, meaning they put more money in the one that did the best and then a little less in the one that did next best, and so on throughout the 6. Now this is a little different approach. Now the reason I'm even more comfortable with this is that its results look pretty fantastic, number one. So let's take a look at the next slide as an example. This is showing the returns over the last 16 years. Now this is showing, remember the S&P 500 index we talked about, right? The S&P 500 index outperforms 96% of equity mutual funds in the marketplace, and in 1999 it had a return of 19.53%. Now when I usually do comparisons, I'm showing from 2000 forward because I want to kind of take a more conservative approach and get out of the 80s and 90s when the market had such a phenomenal period, and deal more with what the last 15 years has shown, where we've got a nice mix. We've shown 2 bear markets and a little bit of, and a good bull run, but at the same time it's, I think, a more realistic approach. Unfortunately, if we look at it that way, look at even there, when we throw in 1999 with that 19% year, the S&P over the last 16 years average return was 3.28%. That's the compounded annual return. If we look at the J.P. Morgan Mosaic, that's the shaded area in the green, okay, you can see a lot less volatility than that blue area, which represents the S&P, and at the same time the average return over that period 5.5%, 2% more. Now we can, is 2% a big deal? Absolutely. If you look at 2% over the last 40 years is an example. If you were averaging 2% on your portfolio, you would have twice as much money. That's how much 2% matters, okay? It's huge over time in protecting yourself and getting the most out of your money. Now, Nationwide Insurance took this style and if they put into an index annuity, all right, with this index. So how does index annuities work? So basically it works like this, and we can refer back to Tony Robbins' book on this as well. He gets into it in his chapters. You know, I talk about index annuities quite a bit in Chapter 4 of my book, 7 Steps to Financial Freedom in Retirement. So for those callers that call in and get the book, and by the way, you can also go on our website, hankparrott.com. There are ways that you can contact us through that. You can send us an email with questions. You can, there's a link to the book. You can get the book there. You can, there's a link to a lot of the material that I cover and a ton of other information there for you at hankparrott.com. Now, when it goes to index annuities, let me come back to that. Understanding what you're investing for. All right, when I ask that question of clients, they might say things like, we can get rid of the slides for now. So when we ask things like returns, you know, they might say, well, I want to get the most money I can get on my money. Okay, what if you lost, you know, all of your money next year? Well, no, I'd hate that. Okay, well, what if you lost half your money? No, that doesn't make me feel much better, right? So we narrow down and we say, well, if it went down maybe 10 or 12%, you know, that I would be okay with, knowing that if I'm going to be in the market, okay, that I'm going to have years like that, and depending on how much stock exposure I have, it could be, you know, in '08, like I said, even with a moderate portfolio, it dropped still 20%. Even though that's half what the market dropped, that's still 20% loss. That's, you know, are you comfortable with that? Some people are not comfortable with any kind of loss. They come in and they say, you know what, I'm like, you know, like the Lord, I don't want to lose any money. Okay, so whatever, I want to get as much return as I can without losing money. What's my best option there? And guess what? That's where the index annuities come in. So imagine, as I showed you there, if you had, when we look at the historical returns with the JP Morgan and Mosaic, if I can get a return of somewhere in that 5 to 6% range, okay, without any risk to my principal, and that's what Nationwide put together in their New Heights product. And if you'd like to know more about it, again, check in with my office and we can get you some more on that. Now, one of the things, again, when it comes to it, is it about returns? Is it about growth? People are saying, I want to get as much money accumulated as I can. But is that really the goal, or should that be the goal? Think of how many people, how many celebrities that we read about in the news, or sports athletes that had fortunes, right? Tens of millions, hundreds of millions of dollars even, and now they're broke. They have nothing. Okay, so what did accumulating all that money? Is it about getting rich, or is it about, what's more important, never being poor? And that means income guaranteed for life. So we're not worried about then, we don't have to worry that we lose all our money and we're broke. In fact, if we've got income, that's what we want. That's the best outcome we can hope for. Guaranteed income for life, that we'll never have to worry about running out of money, that we'll be able to maintain our standard living and quality of life as long as we live, right? That's the real key to financial freedom in retirement. We're going to tell you how to get that when we get back after this break. So join us here. We'll be right back on the Retirement Report.